Ashley, and today we have Miss Nicole Grogan Alston with us. She is a corporate tax strategist born and raised right here in Atlanta, Georgia. She is a mother of 4 and the owner of DNC Accounting Solutions, DNC Business Solutions, and DNC Academy of Entrepreneurship. And today we are going to be discussing how taxes relate to probate and estate planning. Now let's get into this. Okay, Nicole, can you explain to us what an estate tax even is and what does that mean for an individual or a couple in regard to their estate?
Okay, so estate tax is often referred to as the gift tax.
Okay.
Why? And what it is where we are transferring all of our assets over to our beneficiary.
Okay.
And typically, again, just depending on how much the value of that of the estate overall, we may have to pay some taxes on it. That tax can range anywhere from 18 to 40%, especially if we're over that threshold. Right now, being in 2024, 13 million. If we're over 13 million, we're definitely going to be incurring some estate taxes. And so we want to make sure, again, when we're doing our estate planning, that we are aware of the value of everything that we are talking about, everything that we're going to put into our estate. We want to make sure that we know the value of that. When it comes to individuals, again, using these the strategies are the giving out the money while you're still alive, using a life insurance policy, putting the money into the life insurance policy again, because life insurance proceeds are not taxable. So, but sometimes what ends up happening is that the life insurance policy is included in an estate, and depending on the value of that estate, it may be taxable. So we want to make sure that we're definitely aware of that. When it comes to couples, the one thing about couples is that, especially if they're married, if they do not utilize that exemption amount, which is that 13 million, whatever the value of the estate of one spouse at the time of death, the remaining of that exemption passes down to the surviving spouse. So now potentially the surviving spouse can have double. Instead of being 13 million, they can have 26 million.
Wow.
So a lot of times what ends up happening, the surviving spouse is going to be the main one that's going to get most of that inheritance.
Okay. So most of the inheritance.
Most of the estate.
Most of the estate. Okay.
Exactly.
So in the event that happens, like one spouse passes away, what's maybe something that the other spouse can, or is there anything that the other spouse can do to now eliminate or decrease their tax burden?
Well, from the
deceased spouse.
Okay, so if that deceased spouse is over that 13, again, this is where they're going to talk about in this planning. What is that value? How do we get that decreased now?
Okay.
And if in the event that they don't, unfortunately, the surviving spouse will have to pay that estate tax.
So it's nothing they can go back and do after that. The individual passed.
No, because it's all set up in the state. What typically ends up happening, the state becomes its own entity. It has its own EIN number. It's its own entity, and so that an estate return will have to be filed for the estate. And if that estate again is over that 13, or if it's not over the 13, but it has a rental property in there that's accumulating rental income, or if it has some money marketing accounts, some CDs that's accumulating interest, or they were a shareholder in a corporation and they're accumulating some dividends, then they'll be responsible for that estate tax.
Okay, so the key is plan your estate while you can.
Exactly.
Right? Okay.
Exactly. And then plan it to where, and think about it, why not share everything with your loved one while you're here? Show
so they're
them
not
love.
left trying to figure all of this out after.
Correct, because it becomes a burden on them.
Absolutely. Well, thank you for sharing that with us.
Subscribe to my channel to learn more about probate real estate, financial literacy, and generational wealth planning.